Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Thanks for taking some time out of your weekend to listen to this weekend show, which is again going to be focused a lot on the resource sector. In the first half of the show, we are going to talk about more of the precious metals, even copper. And in the second half of the show, it's a shift back over to energy to try to make sense of where some of the opportunities are in the oil and natural gas sectors. We're kicking off the show with Richard Postma, a.k.a. Doc. Doc, it's been a little while since I last had you on the show, but I think this is a good time to give everybody a bit of an update as to where you see the gold, silver, copper charts, as well as some of the underlying stocks. Let's start with gold because gold has continued to remain quite strong. It's, I guess, mostly moved sideways for the last couple months ever since mid-April. Recently, it did go and touch a new all-time high just about a week and a half ago, but that was quickly reversed, and now it's broadly back in this range from about 2,300 to just under 2,500. Doc, I have to ask you, I know you look at the longer-term charts. How are you seeing this setup for gold?
We're at, Corey, another inflection point, I believe. It's a very important one for gold. The next 2 months, August and September, are going to tell us a big story because the chart I'm really looking at on the monthly, the variable I'm looking at, particularly is the MACD. Back in 2020, we had a peak on the MACD in the gold market, and then we traded sideways for months and years. And we are approaching, on the MACD, we're approaching that peak in August and September. In fact, in August, we're going to be very close to the top of that peak. So the next 2 months, I feel August and September are going to tell us volumes on whether we're double peaking here and that we start moving down on the MACD, and that would mean a move down in the price of gold, or whether we take that peak out and continue higher and then stay overbought for a period of time. I think that are your two most likely options.
Which one do you favor more, the breakdown or the breakout?
I favor the breakout this time. Back in 2020, I warned folks right at the peak that things were looking a little precarious and that we might be peaking out. But this time, I favor the fact that this gold bull is not over and it has a lot further to go. And I particularly like the weekly chart on gold right now based on the fact that if you look at the MACD on the weekly chart, the MACD has moved sideways while the gold price continues to move sideways and even up a little bit. That's a very strong indicator to me when you see that type of thing where you're not seeing a breakdown in the MACD. So I believe that we're still in this bull market and that we're going to continue higher. The other thing is the fact that we've had such a great move in gold, and a lot of these gold stocks have done nothing except for some of the larger cap stocks. A lot of the mid-tiers and the juniors particularly have done nothing, and they've come off again. And the fact that we've had such a phenomenal move in gold and a lot of these gold stocks have not moved correspondingly tells me that's very abnormal in that the stocks have to catch up. And that tells me from a fundamental standpoint that we have further to go in the gold bull here.
Yeah, I feel like we've been saying that for years, though, Doc, is that the stocks have lagged. And while many of them have bounced here, very few are at all-time highs, much like gold was just at. Give us specific levels then. If the next 2 months matter so much for this next decision, whether it's higher or lower, what are the actual levels we are looking at?
You mean for gold or for gold?
On the low side and on the high side. I assume the high side is all-time highs.
I think by the end of the year, if we continue to move higher, we could see 2,700 to 2,800 gold.
What about on the low side then? What are we watching?
I don't think that we get below 2,200. The other thing is, another thing that makes me think that we have maybe a little more sideways movement here, and that we could see that happen where if we peaked in some of these stocks for a while and we peaked in gold a little bit, the 12-month moving average could start to move toward the 26-month moving average on the MACD. In that case, we might see a sideways movement for gold and for these stocks for a period of time yet, for a good period of time before we break higher again. And that could mean that we could get down to 2,200. The other thing that I think that we could move a little bit lower on gold in the near future is the fact that I think the odds are very good that silver could move down yet, and that tells me that gold might not go anywhere for a time, because I think we could possibly get down to $27 on silver before the next move up. That's a good possibility. So if that happens, I think that gold, the 12 months moves toward the 26-month line, because there's a gap between them right now. And that could hold, we could see gold move down a little bit along with some of these stocks moving sideways before we get the next move higher.
Well, Doc, just following up on that idea, we've seen gold have a lot different chart than silver, and for that matter, a lot different chart than a lot of the base metals, because gold is a monetary metal. Silver, really not so much anymore. It's more industrial metal than monetary. Now, it generally will track gold as a precious metal, that component of it, but we've seen gold bifurcate from really everything. And gold, a lot of people point to having been in a 13-year consolidation from 2011 all the way through just really this last year, that there's that big cup and handle pattern, and that it's breaking out of this huge consolidation. Couldn't that mean that gold could just keep trekking higher even if silver got stuck in the muck?
Absolutely. That's a very good possibility, and it wouldn't surprise me at all if that happens, because I do believe we're starting to move into a recessionary period. And if that's the case, then the questionable industrial use of silver comes into play. And so silver may lag a little bit yet. And with a very good possibility, silver could move down here a little bit. But I also love the monthly chart on silver, even if it does that, because we're right now, there's not any suggestion of a big move down in silver here yet on the monthly chart. And so that's a positive thing. So because of this, I'm buying every week on these stocks, a lot of them that have not done much, because some of them have moved up. And I talked about that months and years ago, that when we did get a recovery here in these stocks and in gold, that you probably wouldn't see a V-shaped recovery like in the past, but it'd be a step process. And we're seeing that right now with some of these gold stocks and silver stocks. They've moved up and now they're moving sideways in a stair-step fashion. And I think they could do that again before we get the real big move in the future, which I think could possibly be 2026.
Okay. That is still encouraging. Look, silver, even at this price, still strong historically when you consider just how stuck it was below $30 and then even in the teens. Let's look at stuff like GDX then, gold miner ETF. It is still trading low volume, but it's off of its lows from late 2022. It's put in higher lows just this year. But again, it's nowhere near all-time high. It still needs to get to that 2020 high, one that, as you said, you were looking at some of those technicals as they related to gold. GDX doesn't have the same momentum that gold doesn't have the same technical setup as it did back in 2020. What are you seeing in the GDX chart?
Well, I love what I'm seeing on one of the strength indicators, and that's the ADX. The black neutral line has bottomed and it's turned up. That to me is very encouraging. And the fact that the green bullish line has turned up, and I think it's going to continue to turn up for a couple of months here. So, and on the MACD, you have the 12-month moving up over the 26-month in an upward trend. So, and the RSI looks good, like it wants to head toward the overbought line. So that's another indicator that I think we're okay with these precious metal charts right now. And I think GDX looks like it wants to move higher here, which is a positive.
Well, Doc, when you look at charts, I'd be interested to get your technical analysis thoughts on price action as it makes new highs. So we've seen a new 52-week high in GDX. It's got up to 39.41 just recently, which was way above its 2023 peak, which is only in 36, but it's still got a little bit of room to run to go towards that 2022 peak at 41.60. So do you think that if gold still has that potential to break out, I know it's at an inflection point, but if the inflection point breaks higher, do you see it positive that GDX has already made a new 52-week high? It's already higher than last year's peak, and could it make a run at 2022's peak?
I do believe it could. In fact, I think it can run toward the 2020 peak, frankly, right now, with what I'm seeing. And what's interesting, too, speaking about price action, the volume, though, is nothing to write home about. And that's a little bothersome, but that's also good because we know we could be far from a top. And so I actually like the fact that the volume is low because that tells me a lot of people have not yet joined these rallies and that we might have a long ways to go. And if you look at the monthly chart of silver, you've got that cup and handle too. And so it's still in play. And so I think there are so many positive factors here right now for these precious metals.
So, Doug, since you mentioned volume, it is one thing that we've really seen a discrepancy on when it comes to different charts, different individual stocks. Some stocks trading practically no volume, but there are other stocks that we have seen increase in volume. We've had a number of different guests and different technicians, some of which don't care at all about volume. How much weight are you putting into kind of analyzing volume in some of the stocks that you're either looking to buy or already in?
I'll give you one example. When we talked off Mike on this, one company that I hold that I bought right at the bottom and I'm adding as it moves up. But what I looked at back in the early part of the year when we had some big volume in some of these stocks, I looked at the companies that had the big volume and thought to myself that, look, there are some people that are pretty impressed with these companies and are buying at these levels. And with this kind of volume, they're probably not going to get shaked out of their price positions with these stocks. And I'll give you, for instance, one of them that I'm really am adding to as it moves up, because I like to chart too, is Integra Resources. And they had huge volume in March, April, and May, close to 5 million shares being traded. And it made the previous months look like nothing, and it's come off since that time as far as the volume, but it's still hanging up at the midpoint. But the stock also, on the monthly chart, the Bollinger Bands are starting to narrow like crazy, and the stock is grudgingly moving higher like it wants to break out, and the RSI has moved for the first time in months out of an oversold position, and it's trending higher. So that's just a for instance of what I've looked at in some of these stocks to take a position in. And I think those volume indicators back then were a good harbinger of what these stocks might do going forward.
Well, Doc, let's just stick with this, for instance, of Integra Resources. We've had them on the show before. They've got millions of, I think they've got 6 to 7 million ounces of gold in the ground now on all their projects combined. They've got a development project in Idaho that's moving forward with the kind of the slow permitting process and that orphan stage, but they've got a couple other projects that have exciting drilling on it. If you look at the chart, though, Integra was above $10 just in 2020, and now it's down by $1. So it's crashed by 90% over the last couple of years during the kind of this tough sentiment period. Do you think it ever has a chance of getting back up to $10 again or anywhere close to that? Or when you look at the chart, is it something where you see the potential of at least a multifold return on this stock?
I think, this stock could be a 5 to 10 bagger, actually. If we have gold move to levels that I think it's possible based on the amount of dollars in existence that are spread all over this world, and we're going to even see more of them, and we're going to see over time depreciation of those dollars, especially with BRICS coming on board. And one thing these politicians can't seem to stop, and it's spending money, and they put us in a position now where they almost have to prevent a collapse of this economy. So with that being said, all I can see is positive things for precious metals going forward with the way the international community is right now economically. And so with a company like this, where the net present value is probably 10 times less than it should be, I would say the odds are pretty good over the next 4 or 5 years that Integra could do very well. If as they open up mines and if they do a efficient job of producing the gold.
So, Doc, when you're looking at charts like this, and look, there are a number of these charts where stocks are well off levels from 4 years ago, how much do you also go back and look at the overall market cap of the stock to filter in dilution of the shares? Just because $10 5 years ago doesn't necessarily mean, well, most likely these companies have gone through a lot of dilution. So how much does market cap also filter into your calculations?
Corey, a lot. I don't want to get sucked into these guys that keep pushing their companies and they keep diluting shares. I try to stay away from those. I feel you're going to be very fortunate to ever recoup significantly your dollars of investment in those kind of companies. And there are a number of them out there, and they have good prospects, but the number of shares on some of them are just astronomical. And some of them are essentially penny stocks with good gold in the ground. But I don't like to position myself. I've learned over time not to position myself in those kind of companies because the odds of success are against you, I believe.
Well, Doc, even taking this little step further, if we just keep looking at Integra as an example, they only have 88 million shares out. So it's not like they've got a blown out share structure, but they've also acquired Millennium Precious Metals. They acquired a whole other company. So their market cap being at 130 million for having 6.5 million ounces of gold, 3 or 4 main projects, 1 flagship moving towards production is 130 million market cap or an 88 million share structure, a non-starter for people looking at a company that really hasn't blown out its share count.
Yeah, and that's another thing I didn't mention, Shad, and you hit the nail on the head on that. I love their share structure. I mean, with the position they're right now, I just love the position they're in technically and fundamentally. And if they're really careful, this company could really do well. And there's everything. I love the price action on it right now. It just is plotting higher right now. And if it breaks out over the upper Bollinger Band, then the thing is going to run for a while.
Doc, let's also look over to copper then. I did want to get your thoughts on copper, which, look, made a nice run back in May, and then ever since May has really turned around and is now trending back closer and closer to that $4 level after being well over $5 in May. What's your outlook for the copper price?
Well, and I've been negative on copper for some time, and I said that a while back. I could see that it was topping, and we have further to move down, and I think we're going to probably see fairly soon a $4 price on it. And then it's questionable on whether we break lower at that point. I think we're getting close to a bottom on the price where we might get a bounce here. And when I look at the monthly chart, I think we could move back down toward anywhere from $3.50 to $4. And then copper has to hold, or else it's in trouble. And if it doesn't hold there, we're going to move down into the twos. But I don't anticipate. I think right now, looking at the long-term charts, copper should hold its value if it gets down to anywhere from $3.50 to $3.75 in pricing. So I think we're okay in copper. It's trading in a trading range right here, and we're headed maybe down a little bit lower. But I think it'll hold, and it's only a matter of time before copper moves up then.
Well, now, when you look at the copper stocks, if you look at an ETF like COPX, which is basically the GDX of the copper stocks, it's the major producers. They hit an all-time high, COPX, just a couple months back when copper went on that run up to 52.90. It has pulled back down to 42.50. So it's had about a 20% move down. But overall, the copper producers have not fallen out of bed because this is still a pretty respectable price if you're a producing company. Now, if the copper price was to go down into the threes, like you're saying, would you be concerned about the copper stocks and COPX, the producers?
No, I would not. That chart looks okay. I think COPX could move down toward 35, and I think you're fine. And I think we're still in a good position. You don't want it to move below 30. The real danger zone for copper is down around, for COPX is down around 25. I don't think it's going to happen. Although if you look recently at its move up on the monthly chart, huge volume. And so it's reversed here. So we may have a move down for a while. And then if volume quiets down, as long as you don't break through the lower Bollinger Band on the monthly chart, you're probably going to be okay and you'll still be in that trading range. But in the move down, there's going to be a lot of stocks, I think, that will give you a good chance to purchase them at good prices that are copper based.
Yeah, look at that volume spike. The volume really started to pick up in 2021 and really spiked this year. But hey, if you're looking at that lower monthly Bollinger Band, man, that's way down in kind of the 30 region. So there's a long way to go to even threaten to break that level. Doc, as much as I think some of the majors have done better, even some of the mid-tiers have done better, there's still no life in the juniors, whether precious metals or base metals. What changes that?
The only what changes that is time and a higher price for gold. That's the only thing that's going to change that.
Well, we've heard that, and gold's been at a higher price for a while now.
Yep, and that's what tells me I think we have to go much higher in gold. I said a while back that this is the first time that I'll get all extreme in a prediction, because I said I think in this next move over time we go to gold $5,000 to $10,000 an ounce, and we've been hearing that. We heard that 20 years ago, and these guys used to drive me nuts. Oh, we're going to 5,000 to 10,000, and you just shake your head. But this is a possibility going forward because of all the debt all over the world and all these countries in trouble with their debt. And the only way that they're going to solve it is through inflation. And so there's probably more to come. And I think the bond market is telling me that there's more inflation coming, in spite of people thinking that they're going to lower Fed's fund rates like crazy here. And so that tells me that, of course, people say, well, higher interest rates aren't good for gold, but so far it hasn't been a problem, has it? But when you raise interest rates, that just drives inflation even more, because your business people have to increase their prices to stay in business. And so it's going to be a very difficult next 5 to 10 years as far as for inflation and for our economies. And so I think gold has a lot further to run.
Well, Doc, you brought up interest rates there and Fed policy, and there are a lot of eyeballs watching to see when the rate cutting cycle starts. There's a lot of other central banks that have already started, but we've heard for really the last 2 years that it's going to be a series of cuts, 7, 8 cuts, and that we're going to see 100, 150, 200 basis points in cuts. What they're really talking about is doing a 25 basis point hike once or twice. Does that really move the needle for anything, doing 1 or 2 cuts? Or do we need to see a series of cuts that would be something like 7, 8 cuts to really get things moving on interest rates and in the bond market?
Yeah, 1 or 2 25 basis point cuts do nothing. That's nice that they're talking it. In fact, it was, I think, Citibank that talked about 8 cuts this year and into next year for the Fed fund rate. I'll tell you what, if that happens, right now, the bond market is telling me that we're going to have a steepening of the yield curve because long-term yields are not going to correspondingly move that significantly down with a Fed fund rate cut. So we've been inverted for months, but if they start cutting Fed fund rate on the short side, the long-term bonds, according to what I'm looking at, are not in any peril of moving down as far as significantly in the rates. In fact, I'll say that down the road, we're likely to have another leg down in the bond market from what I'm seeing right now, what I'm looking at, that the odds are greater in the future, intermediate future, not near term, but intermediate, that we see another leg down in this bond market. So what does that tell you? That tells you that there is incipient inflation out there that's going to rear its ugly head again.
Oh man, I think everyone still has their eye on inflation, thinking that it hasn't fully gone away, especially just in our day-to-day lives. But we'll see just how many rate cuts the Fed gets off this year, let alone into next year. Everyone loves predicting more and more rate cuts, but fact of the matter is we still need the first one out of the US. This week we had the Bank of Canada with their second rate cut, but still it's a slow process back down. And Doc, if you are right, if the bond market goes through another sell-off, that really throws, I think, a lot of this market rally on its head because of the fact of how much I think that has been driven by that outlook for lower rates. Doc, it's great having you on the show. Thank you again for taking some time and sharing your insights on the precious metals, copper, and now even the bond market. Doc, I hope you have a great rest of your weekend.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. I hope everybody enjoyed those first two segments with Doc. It's focusing more on the metals, precious metals, and copper. Now we're going to shift our focus to the energy sector, oil, natural gas. We're chatting with Josef Schachter, founder and editor of the Schachter Energy Report. Also writes the free report called Eye on Energy, where Josef looks at the overall data for the oil and natural gas areas. Josef, let's start off with the oil price. The oil price has been fading lower as we're recording this. It is slightly under $78 a barrel. Breaking that $80 level, while maybe not technical, is still psychological, I think, for some investors and for the sector. But broadly, I guess we can say the oil price is in a fairly tight range from what we've seen this whole year. What's driving this recent price decline, Josef?
Well, we talked in the last month that I thought the price of oil was going to break 80 and break 75, and at some point we'd find a bottom after that. We're now trading, we were 83 at the time, and now we're below 78. 77.30 is when I wrote the report this morning. Eye on Energy will be available to people later today. And the index, the TSX Energy Index was 288. It's now 283, so it's down 5 points on the week. And I think there's still another 40 points to downside, maybe, so a 15% decline. We've come down maybe 7-8%. So we're not, about a third of the downside has been reached. And I think that with quarterly results from Q2 starting, I think we're going to see that the results are not going to be as buoyant as they were during Q1. Number one, the price of oil is not much better, but the real thing is the price of natural gas in Canadian dollar terms, and for the U.S. companies in their market, are much lower than they were in Q1. So I think we're going to see cash flows lower in many cases, except for companies that made acquisitions, so year-over-year comparisons will be positive. And I think that we're going to see that the ones with natural gas that didn't have good hedges, they're going to have disappointing results, and we'll see what the market does then. But I think with oil heading down, that really controls the market. And so if we break 78 and then we break 75 and you go down $2-3 chunks, each of those is going to have a negative impact on the price of the stocks. And my expectation is that over the next 4 to 6 weeks, we're going to see a buy zone after a pretty nasty market. And I think the general stock market is being brought down by the AI-related names. We're seeing NVIDIA getting hit, ASML. We're even seeing things like UPS get hit because the amount of parcels that they're delivering is down. Consumer spending is down. We're seeing it in the retail side. Airlines are talking about disappointing. We saw Air Canada in the Globe today. So there's lots of reasons for people to be looking for a softer economy. Will we go into recession? I don't know. We've had 2 cuts now from the Bank of Canada. Housing is pretty rough in Canada. Retail sales has been pretty bad. So it's possible that we might go into a moderate recession in Canada. The U.S. is a little different. Yes, the consumer, which is 70% of their economy, is hurting, and we're seeing it from retail announcements left and right of weaker earnings. But remember, the American economy has massive deficit spending, most of it for military to help Ukraine and Taiwan and Israel because of the wars going around the world. So that's going to give the military-industrial complex areas, those areas which are producing weapons, those areas will have a more buoyant economy. But if you're in the grain areas or normal, Midwest manufacturing or whatever, those are going to be the ones that are going to be weak. So I'd be continuing to watch second quarter results across the board, be it banks, how much are they taking in loan losses, and does that impact them? We saw Wells Fargo get hit pretty hard because the number was bigger and they missed on a lot of numbers. And we'll be watching right across the board once the Canadians start coming out. And again, I think the issue there is going to be, what do they say about consumer spending? What do they say about revenue loss? What do they say about accounts payable, accounts receivable? What are their debt loads? And I think that's going to be very critical. And if they come out with guidance that's negative, that will help to drive the stock market down to the levels that I've been talking about.
Yeah, Joseph, there sure are a lot of mixed currents as far as the economic data, a lot of things pointing to weakening data and economy slowing down, not just in the U.S. and Canada, but even globally. A lot of people pointing to China as another engine of growth in the economy that's slowing. But there's also been a narrative, and I'd love to get your thoughts to weigh in on it, Joseph, that some of the weakness in natural gas and oil prices have been the anticipated Trump trade, and that he would want to, and his administration would want to ramp up the drill baby drill campaign and really get more fracking going. But that seems to run counter to what energy companies would want, because they want profits. They want to buy back shares and pay dividends. So what do you make of the idea that there's going to be an increase in U.S. production when we're already at record highs in U.S. production?
Well, we're at 13.3 million, and it's really the Permian that really did that. Eagle Ford, all those basins that have been very prolific, and new pipelines have come on and to bring that production on. And we're exporting a lot of it because it's light oil, and the refineries on the Gulf Coast are processing heavies. And that, of course, is a good advantage for us in Canada, which produce a lot of heavies. And that's going down to the Gulf Coast through the pipelines that we have down there. And then, of course, TMX is now taking heavier crudes to the west, and a lot of that's going to California. And then some of it gets retransported to larger ships and sent to Asia. But the ships that can come into the Vancouver harbor are not big enough to really handle large cargoes.
Okay, well, Joseph, what about that Trump trade then? If it is drill, baby, drill, will that increase production? What sort of impact could the Trump trade have?
They need to have the economics in their favor. So they need to have more LNG exports so that they can produce more oil in the Permian, which then has natural gas as a byproduct, and then they'll have a place for that natural gas to go. So that's really a big important part. The other is they need the prices, overall cash flows to go up. Well, the only way that happens is volume growth and price growth. And the volume growth doesn't happen without the price growth. So the chatter by the politicians, including the Republican Party, that the drill baby drill is going to mean lower prices for consumers is totally incongruent with what the energy companies need. They need more cash flows to justify spending more money and investing in the ground and bringing on more production, not less.
Yeah, I find it so interesting. We're talking about this record production, but we keep seeing drill counts, rig counts go lower. Is this environment sustainable in the U.S., Joseph, where drilling has just become so much more efficient? The wells that they're drilling just are longer. Everything about what seems like efficiency has gone in the favor of these producers. Is that going to stay that way?
Well, the industry, because of the low prices, learned to do different things. They have stacked wells, so they have a footprint on the surface which is small, and they can do 4, 5, 10 wells, 20 wells, 30 wells in some of the bigger cases off of one pad. And then they have different legs. So if you look at the Montney, we have 5 legs in the Montney. So companies are drilling into the 2 or 3 most prolific, but they're also doing wells into the others to show that they have the reserves and that they can always go and bring those other levels onto production at some point in the future. So the same thing is occurring down in the States. There are multi-leg wells being done because of the different pay zones that are there. And so, again, it's an economics issue, but the industry has learned between longer wells, as you mentioned, 2, 3 miles, 5 miles is what they're doing, bigger fracs, more sand, higher pressure, all those things have been learned, directional drilling, all of that has been learned so that they can stay within the prolific zones and produce as much as they can. And the problem, of course, is the depletion rates are high with fracking and with long-reach wells, so the companies have to keep on drilling, but they've been fortunately able to keep that 13.3 million barrels up. And remember, there's also the natural gas liquids. The data just came out on that today. So when we talk about the U.S. consuming, last week, or the data that came out today, the U.S. is consuming 21 million barrels, but the production for crude oil is 13.3, but the production from natural gas liquids and renewables is 9.3. So you add that up, and we've got 22.5 of production versus 21.0, which shows you that the U.S. is self-sufficient. And if the Trump administration comes in, then those numbers will probably go up, and America will be a bigger exporter. But of course, the industry is going to want high prices to justify that new investment, because the pressure is on not only to replace declines and grow a little bit, but shareholders are also putting the pressure on them to a return on investment or return to shareholders. And then they're looking at the two options, of course, of dividends and NCIBs, as we've talked about many times in the past.
Yeah, Joseph, it's a weird tug of war that the companies have between keeping investors happy with share buybacks and paying dividends, but the pressure from policymakers or from some investors to see growth, and they've got to walk that fine line. Is there also a capacity issue in the U.S. or Canada where there's just a point where, due to pipelines or infrastructure, they can't really produce any more dry gas, or maybe they can't pump any more oil because there just isn't enough pipelines? Is that a concern for future growth as well?
Well, let's say Canada separate from the States. Canada, of course, we have TMX, so that's giving us growth for the next year or so in terms of moving heavies to the West Coast. Product won't go in as much because of the issues that we've had with the complaints by the buyers of the crude, so that's going to mean more heavies go that way. In terms of the coastal gas line, they can easily add in compression to, and of course, if there's a Train 2 announcement by LNG Canada, and then we have also Cedars and Rockies LNG, all of them are going to probably be moving gas through coastal, and between expansion of a pumping station or putting in pumping stations or twinning the pipeline, once it's in, that's easier to do. So in terms of natural gas going to the West Coast, that's going to be something we can handle. In terms of oil volumes going forward, maybe if there's a Trump administration, maybe the XL pipeline gets rejuvenated. Who knows?
Joseph, what about rate cuts, too? Rate cuts seem to be in our future in the U.S. Canada just went through its second rate cut. What sort of impacts on oil, natural gas, or the underlying stocks do rate cuts have?
I think rate cuts are really not inconsequential because they really don't, in fact, impact the industry. I think psychologically it impacts mortgage renewals and also the government of Canada, which is, and as many of the provinces are borrowing like drunken sailors, they're going to have a lower cost of funding. But for the individual, it's really going to be related to the benefit for mortgage renewals, because mortgages 5 years ago that are renewing now, remember we have a 5-year system in Canada, not the 30-year system in the States, that 5-6% is a big number in terms of change in amount of payments people have to make on a monthly basis. And if they're tight in terms of their cash flows now, this will give them a little bit of a break. Well, this will be making it, the renewal will make it even tougher. Sorry, it's the other side. Going to the U.S. pipelines, there's going to be a lot more built there. And you look at Enbridge and the deals they're doing in the States, TC Energy is growing more. All the big American companies are talking about growing and putting on pipelines to bring the gas from the Permian in New Mexico and West Texas to the Gulf Coast. So, because there's going to be a massive expansion of LNG. So I think the U.S., which has an easier approval process to bring on pipelines, especially in Texas, I think they're going to have the growth they need as the volumes come on.
Well, Joseph, we're getting ready to get into the Q2 earnings season, and there's a lot of companies that'll be reporting. What kind of things will you be looking at when you dive into these earnings reports? Will it be profitability? Will it be their growth wedge? Will it be their hedging? What are the kind of things you're going to be looking for?
Well, the first thing that I would be looking at is for those companies that have challenging balance sheets, have those improved or have they gotten worse because of the low natural gas prices? And then how close are they to the bank lines? And if they are getting close to the bank lines, that's a worry for us. Because if you remember a number of years ago, 5-6 years ago, we lost quite a few companies because the banks and the creditors wouldn't support them. So that's number one. Number two, I'd be watching the netbacks of the companies. What's their cost structure like? Are they growing their volumes? Anybody related to liquids-rich natural gas is probably going to be seeing some growth because of the premium price for condensate that's needed to move the heavy oil. But companies in the heavy oil like Clearwater, they have an advantage of TMX? How much of an advantage have they taken of that? How much growth did they have? The big problem is going to be in the dry gas producers. So even natural gas producers have some liquids, but if they only have 10 or 20% liquids and the majority of their production is natural gas, that's going to be a problem for them. And I would look at how their debt positions are and what the companies have done with hedging. And then 2025, the hedge opportunity looks pretty good. So we're looking to see if they can lock in $3 kind of numbers and have that recovery in 2025, while Q2, Q3 are going to be tough. And then Q4, hopefully we start seeing a bounce in the price of natural gas because of the Coastal GasLine taking gas for LNG Canada Train 1.
So on the hedging side of things, do you not want to see many hedges in place if you have a better outlook for next year? And if they do have hedges, hopefully they're at significantly higher numbers?
The hedging has to be you don't want hedging at $1. You can't make money at $1. Your cost structure is $1.50, and we're right now trading around $1. So it's a loss position without hedging. And so companies hope that they have enough liquid so that they're profitable on the liquid side, and they don't really care if they're losing money on the natural gas side. But for 2025, you want to be able to show the market that you've hedged sufficiently at high prices to protect your capital expenditure program so that you can grow 5 to 8% or whatever the number is that the board approves, and that you can cover any dividend issues that you have, monthly dividend, quarterly dividends that companies are paying, and that the CapEx programs are well covered based on the prices of the hedge book that they've got and the cash flows that they expect to come in. You want to leave some of it unhedged because, of course, if prices take off, you want to see that benefit, but you want to protect the downside of operational things where you don't have to say during the year we're cutting back spending like we've seen a number of companies do because of the low natural gas price. They don't want to bring on volumes when the economics don't justify it.
Well, Joseph, let's also talk about M&A in the sector, because we saw some pretty high-profile deals last year with both Exxon and Chevron. We saw a couple big mid-tier deals. We just were talking on the show recently about the Crescent Energy merger. There's been a lot of mergers in the past, but do you think this kind of environment will lead more companies to bolt on production or bolt on more fields through the acquisition front?
The difference is the bid and the ask. A lot of the ones who might want to sell realize that the commodity price for natural gas is going to go higher in the next few years as Cedars LNG, LNG Canada, Train 1, LNG Canada, Train 2 come on, Rockies comes on. So 2028, 2029, the value of gas in the ground is going to be worth a lot more than it is today. So do you really want to give that away unless somebody's willing to pay you for it? Right now, a lot of companies are trading under PDP, proved, developed, producing reserves. And at the top of markets, they get paid for the proven reserves that are not producing and probable, so they get paid for 2P. The gap between PDP and 2P could be 4 or 5 times. So why would you sell your stock at a 10, 20% premium now versus potentially a 3 or 4 bagger or more 5 years from now? And that's where I think the price gap between the buyers and the sellers is making transactions more difficult.
Joseph, is there a sector within the oil or natural gas stocks, a group of companies that you find is completely undervalued, one that even though you have some lower price targets for the underlying commodity that you think that maybe the washout has already happened in some of these stocks?
Yeah, some of them would be natural gas related. That's number one. Number two, some of the service stocks are cheap because the activity levels are low. So people can start looking around at some of the frackers. STEP is quite cheap versus where the high was. You've got opportunities in total. It was 1085. Now it's 922. STEP was 482. It's now 431. You look at some of the natural gas players, and they're down quite a bit. I'll give you a couple examples. Paramount was trading at 33.80. Now it's 29.80. You can look at, let me go here, to Crew was 661 at the high for the year, and now it's 398. There's a big one with a gap between them. Birchcliff was 868. It's now 608. So there's a lot of names that are sitting that are natural gas related. Pinecliff is 92 cents. It was $1.68 at the high. So, you could look at a lot of names that are trading much below their highs and be waiting to be buyers when we get this dip. As I said, I think the 283 where we are today on the index for the S&P TSX Energy will go below 240. So you want to wait for that to happen. You want to wait for the Dow to get down to below 36,000 from the 40,000 it is today. I think we could even maybe see 33,000 on the Dow. So I think the next month or two is going to be pretty negative for investing, putting more capital to work. I would husband your cash and wait for the next great buying opportunity. And we'll be reviewing all of the companies in our Q2 reports. So subscribers or people who want to subscribe can review the companies, get their buy list together, and be ready to pounce once we get the shakeout. And when we get these shakeouts, the market has got a lot of fear in it. Then people don't want to talk stocks. They're talking about how much money they've lost. And the reality is when people are panicking, that's when you want to be buying because the value perception, the value is there.
All right, so go enjoy summer, hey? Don't even bother investing in this sector. Wait for that washout, that fade to happen.
Yeah, build up your cash. If you remember March, April 2020, it was gift time on the stock market. If you remember the first quarter of 2009, it was gift time, bargain basements, in opportunity. So I think we're going to see a bargain opportunity. It may not be bargain basement like 2020. I don't think we're going to see those kinds of numbers, but we're going to see a correction of 20% or so in the sector. So from a high of 308 to below 240, that gives you that kind of number for the S&P TSX Energy Index, and getting below 70 on the WTI, I think sets the case up for both oil and natural gas stocks to be bargains and be purchased.
Okay. Well, Joseph, I'm still going to follow up with you at the tail end of next month just to see if anything changes in that time. But you've laid out kind of a general time frame here of when investors should be buying, could be buying, when those opportunities could rear their heads, and right now, build up that cash position. Joseph, thanks for taking time with us on this weekend show. Everyone, thanks for tuning in, taking time out of your weekend to listen to, again, another weekend show covering some of the moves in the metals and commodities sector. I hope you all enjoyed this weekend show. Please be sure to go through our website, podcast, and YouTube channel to listen to all of our daily editorials and company updates. Keep in touch with us and have a great rest of your weekend.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.